Greetings from Pristine. My name is Ankur Kulshrestha, welcoming all viewers to the session on financial statement in the Claritas certificate course. Well, before getting on to the details of this session, let us just quickly look at the overview and the learning outcomes which the Institute wants us to cover. So, in the current session, we will talk about some of the basics of financial statement, which includes the income statement, balance sheet, and the cash flows. Then we are going to talk about a little more detail about what do we mean by assets, liabilities, and equity. Then we are going to talk about the links between the income statement, the balance sheet, and the cash flows, which are basically these three financial statements that we talked about. Then a very important step, we are going to talk about the link between the profit and the accrual, and so to speak the difference also. So there is a fine line of similarity as well as difference between these two aspects. Then we are going to get into the details of income statement, then balance sheet, and after that to the cash flow statement. So the session is beautifully structured to start with a little bit of macro analysis and then one by one zoom into each of these aspects. Once the basic understanding of financial statement is done, we are going to talk about a little bit of analysis part using the ratio analysis and getting a little deeper into different categories of ratios like liquidity, profitability, financing, etc. etc. Well, if you just summarize the key concepts and the order in which we are going to talk about it, it says financial statement, balance sheet, income statement, you have then the cash flows, then some bit of ratios. So up to this point, before this point, it is going to be the basic understanding of the financial statement, and after that it is going to be the analysis part. So the request to all viewers is that while we are talking and covering up to point number 4 here, you should focus on understanding, and after that we will do some bit of application as well. So let me start by asking some questions. The first question is that Claritas is not really an accounting driven course. Then why is a course module called financial statement a part of the entire curriculum? The answer to this question is not very difficult, given the fact that in order to make investment decisions, time and again, an investor or a portfolio manager, or should I say an analyst, does have to look into something known as a financial statement. Now on the slide is 3 conditions or 3 situations illustrated, wherein it says that if the management wants to evaluate the performance of their company, there is a company XYZ and the management wants to evaluate the performance. How do they evaluate it? There is no denying the fact that there are some operational KPOs of each industry, but the point is those are all operational. At the end of the day, you need to show this performance into the dollar terms to different stakeholders, which includes your shareholders, your the people from whom you have borrowed, or should I say the debt providers, the government, the stock exchanges or SEC, employees, your debtors, your creditors, etc. etc. So the short point I'm driving home is that although there is some operational way to evaluate the performance of the company, the same is not complete. The same needs to be done in the dollar terms as well. So how to do that in dollar terms? The answer to that question is financial statements. The second such situation wherein you need a financial statement is when and how can an analyst recommend the finally buy or sell on the stock. Now there is no denying, the fact that the same decision is taken by comparing the market price per share with the intrinsic value, which is also known as sometimes the fair value. The point is, how do we calculate these intrinsic value and fair value? There are different valuation models for it, and again those valuation models are based on, or at least they use some of the terms which are derived from the financial statement. The third such scenario, and again like I'm saying, it is only illustrative, it is nothing that these are the only watertight or exhaustive list. The third such scenario is that the government is investing a company for tax evasion. They are checking if there are some frauds or some tax evasions happening. How can they find out what is wrong and what is right? So, let's say a sales tax sort of thing, which is based on something known as sales. So unless and until the government can actually make correct calculation of sales, it will be very difficult to calculate, let us say 30% of that, the pro rata amount of tax. So how much tax needs to be paid is dependent on the sales, and therefore it is extremely important to analyze again the financial statement. Okay, so I hope the reason, the why, is clear on this slide. In all the forthcoming slides we will be talking about how to cover that up. Let me start the introduction of financial statement by saying that these are any kind of statement or a data or record which provide information about, first, the past and the present of the company. Therefore, which is a very, very important point, that these are not futuristic. These are just not futuristic. Okay, they can be analyzed. Now, by looking at these financial statement, you can find out, let us see what are the keywords here. You can find out the financial position. You can find out how much are the profits and how much are the future cash flows, and you can also then finally take the decision whether or not to invest in the company's security. Obviously, these financial statement needs to be prepared is a matter of expertise and is therefore dependent on a lot of standardized rules and regulations. What these rules and regulation help is to bring a lot of standardization in the financial statement. What it means is company A, company B, company C, and what these rules does is that they ensure a lot of standardization. Now obviously there are so many companies in any country, and the user, the investor or the analyst would want a standardized reporting to be done for the purpose of comparability. Let's say A making sales to B. Now everyone, from a user point of view, wants this simple transaction to be recorded in a standardized manner. So the question is, if every accountant of the world is given the liberty to choose according to his own whims and fancies, it's going to be very, very non-standardized, or should I say a customized set of accounts, which is very good from recording purpose, but the point is very bad from a reporting standpoint. So here I am differentiating between what is known as recording versus what is known as reporting. Reporting is telling to the world, whereas recording is noting down yourself. So the purpose here is that noting is okay, but the point is the ultimate objective of preparing financial statement is to tell about the past and the present performance of the company. So the long and short of it is that the financial reporting standards are the set of rules which are mandatorily to be followed to ensure that the financial statements are consistent. Every country has a specific standard. Let's say in the US we follow the US GAAP. Globally there is a new standard, International Financial Reporting Standard, which is being made applicable in different countries at different point in times, with an objective of following a uniform standard across globe. If the reporting standard didn't exist, then the financial statement can take any form, and this is what highlights the problems of non-standardization. So the standards are the guidelines on how to prepare the financial statement. So the answer how, if you would recall that in the previous slide we talked about something known as why, and in this slide we are introducing the next question of how to prepare a financial statement is the one of the most important things that you and I will be focusing on going forward. Obviously what the second part of the bullet here says is extremely crucial, which is that although there are certain strict rules which needs to be followed, come what may, still there is a lot of room left for interpretation. What it means is that at the end of the day, it is written in a language which needs to be interpreted by a human mind. So there are certain chances where a same line written in the law may be interpreted in a different manner. Okay, so we are going to talk about it a little bit, as we move forward on the slide. Moving on to the next page, let me introduce you to the three main financial statements that we will be discussing in detail. The first of all is the balance sheet, which is the statement of financial position. What is important is that a position can only be understood at a particular point in time. It can not be measured over a period of time. So the way you look at it, that all said and done, where is the position right now? It's a 20-year-old company, then the position will include the actions of 20 years. If it's a 2-day-old company, then the position will include actions done over the past 2 days. But the point is, position is always at a particular point in time. So if I have to write it, I will write as at 31st December so and so. The next financial statement is your income statement, which basically talks about the financial performance. Now what I mean by financial performance here is that whether the company is being run into profit, whether it is run into losses, what has been the performance overall, has it been like a good year for the company, has it been like a bad year for a company, etc., etc. The important aspect here is that the performance can only be measured over a period of time. You cannot measure a performance as at a particular point in time. What it includes is all the revenues, all the expenses, incomes, expenses, gains, losses, anything and everything to do with the performance. What balance sheet includes, on the other hand, are three entities: assets, liabilities, and the owner's equity. So for all those who are looking at these terms for the first time, there is nothing to worry at all, because we are explaining each of these terms in very, very detailed manner in the forthcoming slide. The third statement that I would want you to introduce is the cash flow statement, which talks only and only about the cash flows. So all the receipts, all the payments from whatever sources possible will be covered in the cash flow. And within that cash flow, like we will talk about later, you try and make it more manageable and user friendly by bifurcating those cash flows into three logical buckets of operating, day-to-day operations, investing relating to long-term assets, and financing relating to the capital structure of the company. Apart from these three main foundation pillars, which will talk about different aspects about the company, there are some additional information also which is sometimes published, like MDA, which is Management's Disclosure and Analysis, some information about the directors. There is a lot of SEC filings, everything we are going to talk about in detail. Okay, before getting on to the details of the financial statement, let us also quickly talk about something known as the audit. Now obviously in a public limited company, which means that the shareholder is different than the manager, there is a very, very fat chance, or should I say there is almost 100% probability of something known as a mistrust coming in between. There are a lot of decisions which, if taken in the right spirit, can benefit the shareholders, which are the real owners, and that should be the way. But many a times, because at the end of the day, human is human, there are some pressures, there are some incentives to commit frauds. There is a chance that the management, who are the employees, may not work in the best interest of the shareholder. So what promoters or what shareholders do is that to keep a check on the financial aspects of the management, they appoint an expert known as an auditor who is absolutely independent of the management. The point is that it is independent review of financial statement with a view to catch any fraud done by the management. The auditor reports to the shareholder. It is the shareholder who appoints the auditor. So, an exam question perhaps may be that shareholders reporting is to the management. True, false? Obviously it is false. The management reports to the auditor. Obviously that also is false, because management is appointed by the shareholder. They are not reporting to the auditor. Auditor is an external guy. He is not on the payrolls. He is more or less like a contractor. On the basis of his analysis, he might give you any one of the three reports. What is unqualified means everything is okay, where an auditor is going to report back to the shareholder that, whatever management is saying is absolutely okay, therefore there is no fraud whatsoever. Qualified, the second option, which means that there are some points of difference between him and the management, but the auditor believes that those points of differences are not material enough to change the color of the money. Which basically means is that if there is a profit of $100 million being reported by the management, if it is done by the auditor, it might become $105 million. So the point here is that the amount may be different, but the overall message which is being communicated by this $100 million or $105 million doesn't change much. So the auditor says that, Mr. Shareholder, accept this 2-3 points on which I have a point of difference with the management. Everything is okay. The third and not so desirable condition is the adverse report, which says that there is actually a fraud happening in the company. So auditor goes to the management to review the balance sheet, income statement, and after his analysis and result, he reports back that, Mr. Shareholder, your company, something is wrong. It is not conforming with the accounting standard. The reason is why. So they confront the management, and management gives some of the answers which are not convincing enough for the auditor. So auditor, as a dutiful man, reports back this observation to the shareholder. A very, very important aspect is written in the gray box here, which says that the audit do not indicate whether a company is financially sound or not. They only check whether the accounting policy of the company is correct and follows the standard. What I mean is, let us say, to have a lot of debt on the books is not so desirable, because debt brings you a lot of financial inflexibility, a lot of rigidity, and a lot of limitations. Let us say a company is operating at debt to equity of 10:1, which means for every $1 put in by the owners, there are $10 put in by the debt holders, which is an extremely dangerous situation. But the point is, auditor is not concerned with this soundness. Auditor is not there to check whether the company is being run in a proper manner. Auditor is only and only to review the financial statement, not the operations. Okay, it is the duty of the shareholders and the management to decide which way the company should go, whatever decisions that are being taken, whether it is right or wrong, whether to purchase machine A or B. Auditor will never tell you, but auditor will tell you that if a machine has been purchased, it needs to be backed by an invoice by the supplier. And if you are saying that it has been purchased at X dollar, then the same X dollar amount should match with an invoice. Whether X is more or less compared to the market rate, it is the management and the shareholder to decide. Auditor has nothing to do with it. Okay, so more or less it is like a question or review for safety, which is conducted by the shareholders over the management. Let us talk about some other information, which says that the companies whose stocks are publicly traded, which is the public limited companies, are required to furnish much more information compared to a closely held companies, and those informations other than financial statements are to be filed on the website. So it is like your SEC, which is the big daddy of all the stock exchanges in the country, will control all the listed companies, listed company 3, so on and so forth. Okay, now every listed company under the orders of SEC needs to file major reportings, like any significant event like M&A happening, or any director being appointed. So there are different forms for each of the major happenings. So if, let's say, a company has filed the quarterly financial statement, there is a standard form in which that needs to be filed. If there is an annual financial statement, we will file it in 10K, so on and so forth. Okay.